This video is an uncovered Japan company research report on AGC, ticker 5201. AGC is Japan's original glassmaker, founded in 1907. But today, it is a global materials company spanning architectural and automotive glass, electronics, chemicals, and life sciences. The central investment question is simple. Can its world-class specialty franchises and resilient cash generation finally lift returns on equity? At the report's reference date, AGC traded at around 20 times forward earnings and 1.05 times book value. The valuation cannot be understood through the PE alone because earnings have been distorted by impairments. The more useful contrast is a 50.3% equity ratio and a modest 4.7% return on equity. The balance sheet is genuinely sturdy. The open question is whether the capital earns enough. AGC sells business-to-business materials rather than consumer brands. The opening image shows the breadth: float glass production, semiconductor mask blanks, head-up display glass for cars, and industrial chemicals. The portfolio is deliberately mixed. Mature glass and commodity chemicals provide scale and cash, while high-function products such as EUV mask blanks, specialty fluoropolymers, and automotive display glass provide the potential for better economics. The segment mix explains both AGC's resilience and its tension. Chemicals and electronics together generate roughly 80% of segment profit, while representing only about 45% of sales. Electronics carries the highest major segment margin, supported by EUV blanks, even as weaker display glass weighs on it. Automotive profit more than doubled in fiscal 2025, while life sciences remains the major drag, losing 22.3 billion yen. Revenue has held near 2 trillion yen since fiscal 2022. That stability is valuable, but it has not translated into peak profitability. Operating profit fell from 206.2 billion yen in fiscal 2021 to 127.5 billion in fiscal 2025, with margin down to 6.2%. The small fiscal 2025 improvement may signal a floor, helped by automotive pricing and mix, but not yet a completed recovery. AGC's operating cash flow has remained in a 210 to 330 billion yen band over 6 years. Fiscal 2025 free cash flow was 96.1 billion yen. This matters because impairment charges pushed reported earnings into losses in some years without stopping cash generation. The report's conclusion is not that impairments are harmless. They are a real capital allocation warning. But they do mean cash flow and operating profit are more informative than headline net income here. The balance sheet carries an equity ratio of 50.3% and a debt-to-equity ratio around 0.42 times. That gives AGC meaningful resilience. Yet the same chart shows the valuation constraint. Return on equity has been low and volatile, recovering to only 4.7% in fiscal 2025. For an asset-heavy company, stronger assets do not automatically command a premium. The market needs evidence those assets can earn better returns. AGC's competitive edge is not a single patent or consumer brand. It is a stack of industrial advantages. In EUV mask blanks, qualification is demanding and switching suppliers is risky for chipmakers. Across glass and chemicals, scale, local manufacturing, and vertical integration improve utilization, cost, and supply security. The portfolio also limits reliance on any one end market. The trade-off is that the same diversification can blur accountability and dilute group returns. Management's Plus 2026 plan targets 2.4 trillion yen of revenue and 230 billion yen of operating profit. Fiscal 2025 delivered 2.06 trillion yen of revenue and 127.5 billion yen of operating profit. The report judges that closing the 100 billion yen plus profit gap in 1 year is extremely unlikely. Investors should watch operational milestones rather than assume the headline target arrives. This peer comparison is the heart of the valuation case. AGC trades around 1 times book because its return on equity is below the peer norm. Higher return peers such as Saint-Gobain and Corning command higher price-to-book multiples, so AGC is cheap on assets, not obviously cheap on earnings. A credible move from 4.7% ROE toward the sector norm near 6.5% is the key re-rating condition. The report's own scenario framework illustrates the range of outcomes rather than offering a recommendation. The 3-year bear case is 5,500 yen if life sciences stays loss-making and core conditions remain weak. The base case is 8,200 yen if pricing holds EUV improves, and life sciences reaches break-even. The bull case is 12,000 yen if the plan is delivered and returns improve materially. These are stated assumptions, not targets. AGC combines a resilient balance sheet, steady cash generation, and a genuinely differentiated semiconductor materials franchise. Its discount is equally clear: low return on equity, a loss-making life sciences business, and a record of plans that have run ahead of results. The scorecard is therefore balanced. Watch EUV demand, the path to life sciences break-even, core pricing discipline, and above all, whether management delivers a credible roadmap to higher returns. For a much deeper look, visit the free deep dives at uncoverjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security.